Hey everyone, Galen Hair here. Today's video is going to be about RCV, replacement cost value, versus ACV, actual cash value, as it relates to contents, your stuff. So the best way we can do this is through an example. So I'll give you the quick description and then we'll move to our example. If the description is confusing or weird to you, you're not alone. Insurance professionals mess this up all the time and so do new attorneys. So if that's confusing, just go back and listen to the example I give you at the end because that will make it make sense. So RCV, replacement cost value. What that means is essentially what it would cost to get your thing like new. ACV, actual cash value, means the value of your thing right before it was damaged by the loss, whether that's a storm, fire, or something else. I know, that still sounds weird. So how do we figure that out? We figure that out usually based on age and condition. Are you ready for our example? Let's do a TV. Let's say you bought this TV 3 years ago, so it's not a brand new TV, and you bought it for $2,000. Well, if we have an RCV policy, ultimately you're probably going to want that $2,000, enough to get a new TV that's kind of that size from that brand. Maybe it'll even be a little more expensive now. There's no way to really know, okay? But either way, you know that you want a new TV. But let's say you have an ACV policy. And honestly, even if you have an RCV policy, we still have to do this exercise, but I'll explain why later. Let's say you have an ACV policy. Under an ACV policy, you don't get what it costs to buy it new. We have to figure out what it was worth right before the loss. So remember in our example, we have a 3-year-old TV that you bought for $2,000. How long do TVs last? Well, some people might say they can last for 10, 20 years. Other people might say 5 years because of frankly, how flimsy some of the new technology is. So we've got to figure out what the expected lifespan of that TV is. To make it easy, I know many of you will disagree, let's call it 5 years. So this was a 3-year-old TV, which means essentially we're 60% through our expected lifespan. So that means only 40% of life is left on that TV. Let's assume it's in average condition. So we're going to take that $2,000 we spent, and under an ACV policy, we're only going to get 40% of that amount. Wow, that's really not that much, right? At the end of the day, that's going to be $800 for that $2,000 TV. And you might say, but Galen, I can't replace my $2,000 TV for $800. You're correct, and it sucks. And it doesn't feel fair, but at the end of the day, your policy said you only get ACV, so that's what you're stuck with. Now, there's things we can do. We can argue about the expected lifespan to kind of increase the amount you get. We can argue about the condition things are in. But ultimately, if you have an ACV policy, all your stuff will be measured based on what it was worth right before the loss. Now, remember I kind of hinted earlier that you need to know this even if you have an RCV policy? Because they're usually going to pay you ACV first, and then you can get the RCV amount once you replace the item. So in our example, if you'll remember, $800 for that $2,000 TV, that first check is only going to be $800. You're going to need to take that and then buy the $2,000 TV. I don't know what that means for you, whether you need to come up with the $1,200 yourself or you need to take out a store credit card or something, but then you're going to actually have to submit that $2,000 receipt back to the carrier, and then they'll pay you the difference. That's called depreciation. So no matter what, you kind of need to understand how these things work. But don't worry, if it's confusing to you, this is what we do for a living. We do it every day. Not only will we explain it, but we'll help you walk through the process you have to go through to get the funds that you're owed.